So, Venkat, you were telling me that there's some new credit offering by Paybuddy. Maybe you can tell us a little bit about this offering.
Sure, sir. Okay, so just to be clear, so far we have been talking about these Paybuddy Paytm as just a wallet where you store all your existing cards, right? You have a HDFC credit card, you put it there. You have an SBI debit card, you put it there. So it is just acting as that intermediate party to enable that thing. Now, over a period of time, what has happened is these companies like Paybuddy and all these Paytm and all, they have been trying to go further up. They are saying that now I'm not only going to do that basic transaction, I'm also giving you credit myself. So even let's say you might be a person who doesn't have any credit card, but I am going to evaluate you and I am going to give you something like a virtual credit card where I am going to give credit from my own pocket. Like just to tie it to the earlier example, in the earlier example, Paybuddy didn't put any money from its pocket. It was just taking money from your bank and giving it to the merchant. In this case, Paybuddy is actually taking its own money and giving it as credit to you to make you do the transaction. So that is this whole concept called buy now, pay later, which a lot of online companies are doing today. You can see on the screen this Amazon pay later option, right? Even in Amazon, typically when you buy something from Amazon, again, you can store all your cards there and you just tick your whichever credit card you want to pay that thing with. But today, Amazon is also giving you this option where it is saying that you don't need to use any of your existing cards. I am giving you credit. So you buy something from me today, but you pay it back over next 3 or 4 months.
So this is given to everybody? Amazon gives to everybody, or they select people?
There is an application process involved. So essentially, any company that does this, they have to know that you will pay it back, right? I mean, what if you run, you never pay back? So that
Exactly.
much they will do when before they are giving it to you.
So only if you have been buying Amazon product for some time and paying only, then only they know, right, about you. Then only they'll give.
There are, I think we can, we'll come to it, but just at a high level, there are two ways in which they can know whether you're a good credit worthy person, as we call it, right? Like somebody who will pay back. One is they have a lot of data about you. They know your history, like you have been a regular customer for the last 3 years. So when they give something, they know that they have the confidence that you pay back. That is one way. Another is they can purchase what is called as a credit score by these external companies like CIBIL and all.
Oh, okay.
External companies called like CIBIL in India, whose only job is to create a credit scoring for you. They will say, like, they will give you a score like, let's say 750. 750 means it's a fairly good score. It gives a confidence to anyone else that you will, if you are a guy, if you take a loan, you are most likely to pay back. So they can leverage that external score also to decide whether to give you this pay later option.
So, Venkat, one thing that is not clear to me, right? So, when you said when I use Paybuddy to pay 100 rupees to Amazon, I understand very clearly how Paybuddy makes money. Okay, Amazon will pay Paybuddy 3 rupees. What is the advantage to Paybuddy of giving me credit? How does, because will I pay them interest?
A good question, sir. So there are multiple variations to this. All these companies have something called a long-term credit option where they charge interest. Like say you can take a small, let's say you are buying something today and you take the option to pay it back over 12 months or 18 months, then they charge an interest. But in most cases, these buy now pay later are more like 2 to 3 months kind of credit. Okay, you buy something today and you pay it back just in 2 months from now or 3 months from now. And in these cases, they don't charge any interest at all. There is no interest, there is no late fee. Then how do they make money? It's again the same concept that because they are giving you this option, the belief is that you become more engaged to that particular platform. You start making more transactions. So in a way, like let's say in a normal world, you would have done 2 transactions in a month. So the Paybuddy is going to get that cut for 2 transactions. Because they are offering you this extra credit, maybe you will make 3 or 4 transactions. Then they are going to get that additional benefit from you as a loyal, engaged customer.
I see. So they basically want to drive volumes up.
Exactly. Yeah.
I see.
volumes up from the same customer, is what I understood, right? Engagement. So engagement, okay. So which means you want the customer to keep coming back again and again to you. That's
correct. Yeah, exactly right. I mean, once you take this loan, you're going to interact with the platform a lot more because you have to pay back every installment. Again, you come there. Next time you buy something online, if you find this a very convenient option, by default, your mindset will be to choose this as a payment option. So there are multiple benefits to offering this kind of thing. Essentially, in your mind, for any of your financial needs, you will start looking at Paybuddy as a single option for you.
Very nice. So let us say I buy one 30,000 rupee phone, and I choose the 3-month buy now pay later option. So what happens? The phone comes to me, and then 1 month from now, Paybuddy will tell me to pay 10K. Is it? Is that how it works?
Sorry. Sorry. Yes, sir. So any installment is divided into 3 or 4. Any amount is divided into 3 or 4 installments. So in this case, if it's a 30,000 rupees mobile phone, let's say it's 3 installments. Paybuddy initially is putting that entire 30,000 on behalf of you, giving it to that merchant. Let's say you're buying it from say Amazon. Paybuddy is immediately giving the 30,000 to Amazon, and you get the phone immediately. Then after that, every month, you are expected to make the 10,000 rupee repayment back to Paybuddy and close it off in the next month.
I see. I see. And they will send me reminders every month, is it? Saying you have to pay us 10K or whatever?
Correct. They will send you reminders, and let's say you miss your payment, then they have a collection mechanism where they will call you and all.
I see. Okay. Okay.
Typically, another
little bit like credit card, but there is no interest.
Exactly. This is exactly that the main, this is a very new concept, fairly recent concept, is buy now, pay later. It is similar to credit card, the main difference being that there is no interest. So it is supposed to be a bit more benefiting for the end consumer. Second, I think we'll see it when we look at the data. Typically, the amount we are talking about is smaller here. In a credit card, you are buying gold jewelry worth like lakhs of rupees. But here, the amount you're talking about is typically, let's say, in the Indian context, I would say 1,000 to 3,000 rupees. In the US context, we're talking about $100 to $300. So the amount value is lesser, and there is no interest fee or anything for the user. But yeah, the end user, it is beneficial, and he's able to make more transactions than he would have done otherwise.
Understood. Understood. Okay. So Venkat, can you give us, a little bit of an overview of the case study? So in this offering, what is the sort of data that is available on the one hand, and what is the business problem that you in Paybuddy are trying to solve?
Sure, sir. So as I said, we are in this case study, we are assuming that Paybuddy is an existing company which is doing the normal online payment service, and newly it is launching this buy now pay later option, which, as we discussed, is something like a credit kind of option, right? Now, there are two important business questions that they have to answer when launching this new product. Right? One is, out of all my existing customers, which customers are more likely to adopt this new product? I am probably an example myself, right? Whenever I go to Amazon always keeps showing me this Amazon pay later, take this. I never click that option because I don't find any need. I have my existing card. I am always most likely to pay with it, right? Maybe I'm not exactly a good customer for Amazon pay later. But then maybe somebody else, let's say my nephew, he is just completing his college. He doesn't have any credit card in his name, right? But maybe he needs credit. Maybe he wants to buy a new mobile phone. He will most likely, he can have a bank account, right? Maybe his father has opened a bank account for him, but that bank account doesn't have enough money to buy one mobile phone upfront immediately, right? So he is a good customer for pay later, because therefore now instead of paying that 30,000 for a mobile phone in one shot, he gets the option to pay it in 3 installments without any interest fee. So he's a great customer. So basically, this question, right now, who is Venkat is not a great customer for pay later, but Venkat's nephew is a good customer for pay later. This question, who is the right customer for this out of all my existing customers? That is a main fundamental question that they have to answer before while they are launching this product. So it's more of a market question, deciding the right customer.
Venkat, I presume it's a combination of customer and product, right? Because understand that if he wants to buy a mobile phone, your nephew might choose pay later, but if he wants to buy something else, he may not necessarily choose pay later. I mean, it depends on the product also, isn't it?
Right, sir. No, absolutely. I think I missed that point, but yes, one is about who the customer is. What his life stage is, what his income. All these characteristics about him. That forms one dimension. But equally important dimension is what is he purchasing, right? Maybe sometimes people are more likely to choose these pay later options when they are purchasing electronics items. Maybe they are
impatient. We heard it from our e-commerce case. Nobody wants to wait for a phone. They have decided they want to buy. What do you call it? High intensity purchase, something.
Correct.
They have decided they want to buy the phone. They want it on their desk today, tomorrow. They don't want to wait.
Interesting. But maybe there are other things. Let's say maybe you're buying groceries. It's very uncommon to think of buying groceries with buy now pay later, right?
Correct. Because also the guy, I mean, it might come after 4 or 5 days. You're willing to maybe able to pay 4 or 5 days later. And it's a smaller amount of money.
It's a smaller amount of money, and that's like you said, right? Maybe a mobile phone, you want it immediately on the spot. There are other things, and these are also not planned purchases, right? They are more like impulsive purchases. Maybe at least for a grocery or your regular expense. Typically, most people try to make sure that the bank account has enough money to take care of their regular monthly expenses. But not everyone plans for an impulsive mobile phone purchase and keeps money ready in their bank account. So I think a good point, which is that not only the customer, the kind of product he's purchasing also acts as a determinant factor, whether he chooses pay later option or whether he sticks to his existing, any other funding mechanism.
So it's interesting when you said this, Venkat. I was just thinking back about the conversation over the last 15 minutes, and what struck me was that intuitively I said mobile phone, I will use buy now, pay later. And you also took the same example. So in reality, is it so that for mobile phones, people do use this product?
Yes, sir. I think
or that's not the case in real life. It was just an example we picked.
No. I think it's very true in real life as well. Electronics, as we call it as an industry, is definitely typically high on these kind of pay later kind of options. Another industry that comes to my mind is travel. When people go on vacations today, it's very common to plan international vacations, right? And
you have to go on vacation when you can go on vacation. You can't delay, do all that. Right. But you don't have the money. Very nice.
So that is also typically these kind of things, right? I mean, and again, travel and all is a very good example of. I believe probably 70% of travel purchases must happen online. Like maybe 10 years today, everyone purchases tickets on MakeMeTrip, Yatra, these kind of online merchants, right? So again, the option to take credit also becomes very easy, and these are also good industries for pay later kind of options.
I see. Interesting. And it will be interesting to see if some of these patterns we can see in the data. Huh?
Right. Yes, of course. Yes.
Maybe I'll also give a brief on the second problem we are talking about here.
Sure.
So marketing, right? Which is which customer or which transaction is the right transaction to advertise this pay later option. Since I'm launching it new, I want to decide all this by looking at all my transactions. So that is one marketing side of problem. The other equally important, or in fact even more important, is the problem of who do I give this, right? Because I cannot give this, as the professor asked earlier. I cannot give this to anyone because I need some assurance that the money will be paid back. I'm interest income in this, so I definitely want the money to be paid back if I can run this business sustainably over a long period of time. So essentially, before giving somebody this small loan amount for under buy now pay later, I need to have an assurance that he will pay me back, and that is called credit risk evaluation. Essentially, I decide whether this person is credit worthy. So, and during the transaction time, when he clicks on that option, I sort of backend, I need to run some rules or models or whatever you call them, decide whether I will approve or not. If I think that the person is not credit worthy, I'm going to decline. I'm going to say, boss, I'm not going to give you this pay later option. You will, based on your history, I don't have enough confidence in that. So you might have to choose some other way to pay this transaction.
So I'm just thinking intuitively, right? When my friend comes and asks me for a quick loan, I typically make, or acquaintance, I typically make that judgment saying, I have a rough idea of how much this guy earns. I have a rough idea of, does he have any other loans? I have a rough idea of what responsibilities he has, what committed payments he has. So is this what you mean by rules or models?
Sort of, and maybe like the dimensions you gave, or the perfect dimensions when you have all that information about a customer. So typically, like equivalent is when a bank gives you a home loan, right? They do all this. They take your last 6 months income statement, like salary statement. They take your existing loans. They take guarantors, like people whom you know and all. So all this happens in a traditional credit kind of scenario. Now the problem in the companies is they cannot. I mean, let's say you're trying to buy a mobile phone online. If they ask for your income, salary statement, you're probably most likely not going to skip off that option and go do something else, right? So reduce the friction that you will have to go through. The moment they ask for details, you're like, okay, check this. Let me just buy it or not buy it later. Like you'll throw it off. So they don't want to ask all that information to you. But on the other hand, being that online technology company, they have other data points about you that are good proxies for indicating your financial health. Right? For example, how many transactions have you made in the last 12 months? How many transactions have you made in the last 24 months? Did you make all these transactions using your credit card, or were you able to make some of these transactions using your bank account? Right? Because they are these wallet companies, right? They have all this information about you. Did you what was the total dollar value or rupee value of the items you purchased? Like, say, are you a person who was able to purchase only 2,000 rupees worth of things in the last 1 year, or did you purchase maybe 20,000 rupees worth of things? Right? What is the quality of the credit cards you have in your wallet? Like, do you have some premium card? Like maybe in the US, Amex is considered to be a premium card. Right? And even in India, we have these, sometimes you get a platinum card, sometimes you get a silver card, right? So all these are what I would call as proxy indicators of your credit quality. They are not as good as your, like you said, rightly said, Professor, it's not like I know your income, I know your existing, I don't know all that. But I have some other things that seem to correlate well with all these, your financial health. So using these kind of data points is how typically most of these companies do their credit decision.
So if I can put it like this in a layman's term, you are going to take a guess about somebody's ability to pay back. And what you're saying is, just by looking at some of these proxies, you are able to make a very good quality guess. Is that what you're saying?
The official word in finance, I mean, Venkat will clarify, is risk, I guess. You're taking some risk here. Hopefully, the payoff is good for that risk you're taking.
Absolutely, sir. I think both are correct. Basically, it is sort of an educated guess. It has some level of risk, right? No, like it's like sort of in the statistics terms, I can say I'm doing a probability assessment whether you will pay back or not using all the I have. Even if you're a great guy, like you have been paying, like making so many transactions in the past, everything is good about you. So that probability score might look like 0.9, right? So that means that there's a 90% chance that you will pay me back, but there is still a 10% chance that you will not pay me back. That is I'm trying to live with, because I'll never know 100% whether you will pay back or not. Even you yourself will not know like what will happen down 3 months. But there is some level of risk I'm willing to take based on the information I have.
Right. Very interesting. Very interesting.
Yeah. Okay.
Should I? So maybe these are a couple of the scenarios, right, Venkat?
Correct, sir. So this is now we looked at the two broad problem statements, right? One on the marketing side, the other on the credit risk side. Now this is going a bit more deeper level of what it means to make those decisions. So I think this is structured a bit more like a conversation. So maybe I'll explain this concept called nudge economics here from a marketing perspective. Maybe we can go to the next. Yeah.